welcome to the Capital Discussions Roundtable. I'm Tom Nunemaker, and today we have our special guest, Matt Shaffer, calling in from Chicago. Before we get started, quick disclaimer, the Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And we have this disclaimer at the bottom of all our web pages, and I'm sure, Matt, your firm also has a number of disclaimers. So while we're transferring the ball to you, I know Jim has known you a lot longer. A few words about Matt.
I've known Matt for, I guess, on and off now for about a year and a half or so. Matt has done a lot of the trading for EAB. Remember, that's the hedging company that I've been working with now for about 2.5 years. A lot of the stuff we do, almost all of the stuff we do, gets executed through Matt. Matt is not only on the floor of the CBO for our larger contracts, but also ends up shopping orders for us, has a number of relationships. And I just thought with the market becoming more volatile the way it has, you know, I don't know if we're in a market pattern like we were last time, where the chart basically looks like the path of dropping a golf ball off of the Empire State Building, right? We go straight down enormously, we hit a bottom, and then we start to come up with today's movement up. There have just been so many things going on. I thought, why not go to the source? Why not have somebody who's on the floor, sees this, is shopping orders all the time, be able to kind of just end up talking to us a little bit about what's been going on. Matt sends out an email to all of its institutional clients, both in the morning and midday, kind of like, the flow from the floor is what I called it. You know, the order flow, what was going on in the news, what he ends up hearing. He'll end up seeing certain trades, and I think it's enormously helpful to get you a feeling for the way the market is moving. If there was one advantage that floor traders used to have, it was to end up watching how the order flow would come in. Matt and I were talking just a couple of days ago, and really that advantage is basically gone except for in two pits, and they're arguably the two most important pits in the world. It's the SPX pit and the VIX pit. And to be able to end up having a peak inside of that world, I thought would be enormously helpful for that. Matt's been trading a long time, and I can't do his intro justice. Matt, before you start, would you just give us a quick, a quick picture of your long and very successful career?
You're too kind. So I started back in the early 90s on the floor of the Philex. I was the specialist in Dell Computer and in Staples during their whole merger takeover deal. I moved out to San Francisco and opened basically what they call an LMM operation, which is a specialist unit running a pit of some 500 names with 10 people, and trading the heyday of the 90s and early 2000s with the tech bubble and crash. And we traded Enron. Most of the order flow and options of Enron went through us on the P Coast. After our company got bought and after the whole fizzle, I moved to Chicago and worked upstairs for a large bank. I don't know if I should say the name or not. It doesn't really matter. Trading on a dispersion desk where we trade vol, basically index versus the components. We looked for opportunities in volatility and in skew and traded against the index. After that, I went upstairs to another prop desk and traded another 500 names and looking for various situational opportunities in earnings and vol and any single situation that would present itself. And then I traded a little bit gold and silver options for a relatively small firm before joining Englander, where I'm doing advisory help for EAB and also executing for our hedge fund clients seeking liquidity. I have a lot of contacts in the street. We have people in the S&P pit here. We also have people in the VIX. So we have our ears and sniffers basically all over on every exchange where we're able to see, some of the order flow. So that's pretty much my background. I've experience on the prop side. I have, I have upstairs experience, and we have relationships basically all over the street.
Thanks, Matt. I'm sorry. I went to respond and I realized I was on mute because I'm at an airport. I didn't want the background noise to come in.
Nice.
Matt, with everything that's been going on the last couple of days, and, Tom and I are lucky enough to receive your institutional letter that you end up sending out. Can you talk to us a little bit about, like, for example, this afternoon's letter, yesterday's letter, whatever it makes most sense? Could you just give us kind of like a little recap what you end up doing in the newsletter? The type of things that institutional funds, clients of yours are interested in hearing from the floor.
You'd be surprised, it's from an institutional side and a retail side, I think people are generally interested in similar things. We look at flow and we see a lot of directional type trades, but we also see a lot of volatility type trades. And, our expertise is interpreting what these customers are trying to accomplish. And it seems like lately more than ever, I don't know if it's the efficiency of the marketplace or people just having a strong conviction, but a lot of the directional flow seems to be pretty on the money lately. And I have a few examples, both on a market basis and on a single stock basis.
I'd love to end up hearing that, especially because, one of the expressions that I end up using is that because options are the most efficient, effective way to end up using leverage in a direction, many times you'll see institutional money end up moving in that. And I use the expression that, if institutional money is going to end up moving in a direction, and they're going to end up trading, they can hide a lot of things, but they can't hide volume, right? They can't hide their size. The expression I end up using is elephants leave footprints. And you see those footprints. Can you give us a couple of examples?
I'd love to. So one single stock example that's pretty egregious, I don't know if people on here follow it that closely, was a biotech stock, SLXP, I believe it's called Salix. Here's an example of some of the flow that we were seeing as recently as March 5th. We had a buyer. We had a buyer of over 21,000 April 160 calls, which was only the beginning. And then the following day, we had all these outright purchases. And this is a stock, I should give you a little background, I'm sorry, that was taken over for $158 a share in cash. And it looked like a done deal. And there was no reason that anybody should be risking money to play a 160 strike call. So the following day, we saw 4, decent-sized buyers of April and March 160 calls, which, are in the business as we call rip-ups. They should be worth zero. Meanwhile, people are paying, 75 cents a contract for 7,000 April 160 calls, which kind of raises a red flag that somebody knows something. We don't know what it is. It doesn't really matter. We just know someone's looking to play some type of upside event. And as you know, anybody who... Yes, sir.
Hey, Matt, you're not sharing your screen. I think you wanted to.
Okay, I apologize. I thought I was before. I must have, let me see. Is that in the quick... Here we go. Share start menu.
There we go.
Is that better?
Yep, we got it.
Okay, so that's...
Yep, we're seeing that. By the way, one quick comment. Rip-ups is a term that they use on the floor because they write the ticket and they might as well rip it up because it's going to be worthless, or at least so that we end up thinking. So that's the term that they end up using in terms of rip-ups.
Shoot. Hey, guys, oh, shoot. I apologize. I have a phone ringing in the background of my booth. I can't. Oh, I guess I'll just... Sorry. Yeah, so rip-up meaning there's no reason that these calls should ever perform at all. And obviously, they did. Jim, are you trying to call me? Can you guys hear me?
Yes, I can hear you. I think it looks like Jim might have lost the connection, but you're fine. We can hear you.
Okay. I apologize. I'm getting a little technical difficulty here. Okay. Anyway, if for those who didn't know what happened with SLXP, we had the buying here March 5th and 6th, and then there was a takeover announced and the stock went up basically $12 from there. So all these calls were massive, massive winners. I think it was like if you netted all the calls that were bought, there was a total of between 50 and $100 million made off somebody knowing something and other people piling on. So that's just one egregious example of following order flow.
Matt, as you're pulling up the next example, one of the things that I've seen whenever I've talked to, floor traders, when somebody is paying an outrageous price for a stock to end up moving in one direction or another, and what I've always seen is that market makers or specialists, right? Specialists, the guys who actually have to stand in the pits and fill orders, when they'll raise the price and they'll start to end up moving it a little bit. But if they hit you once, they hit you twice. At some point, okay, what I've seen every smart market maker do is step back and say, wait a second, obviously this guy knows something that I don't. Could you talk a little bit about that process, the way you see that order flow?
Yeah, it's very interesting. So if you have, let's say, call buyers of a certain volatility, if I can speak in those terms, if somebody's buying a 50 or a 55 or a 60 volatility, and you think it's worth maybe 40 to a 50 range and you feel it's a little expensive and you start making sales, okay, no big deal. I'll sell these and I'll look to do something against it and hopefully I can lock in a small profit. So all of a sudden, if you have volatility starting to trade to 70, 80, it starts getting a little suspicious. Maybe you make some more sales, but you're a little hesitant looking for a little more information. And then if you have volatility go to 100, you might be like, maybe this thing's a buy. Maybe you want to get on. It seems somebody knows something. There's something the market is not aware of that somebody's aware of. And if it's too good to be true, it most likely is. It may be a directional player. It may be a volatility player. You may have thousands and thousands of call buyers, and then the next day, a company announces some kind of bad pre-announcement. It turns out the person who was buying calls was actually selling stock against his call purchase, and you have a stock down 20%. So it's not always in the same direction, but lately it does seem to be in the same direction. Do you want me to give another example?
That'd be great.
Sorry about that. That would be great. Yeah, I think that these are types of things that people really end up need to hear.
Certainly. So, with the last few days, we had the market selling off, and in general, we have a product that a lot of people look at, EEM, which is the emerging market ETF. And so over the course of the past week, generally there's put buyers in the name. A lot of people use it to hedge their long portfolio. They may have exposure to emerging markets, and while they might like the names that they own, they'll buy puts in general as a correlated hedge to their book in case the whole market swoons. Well, the other day after the market had sold off a lot, we started seeing some serious bullish flow in EEM, which is pretty rare. We had 20,000 June 38.5 puts sold. We had 10,000 March 38.5 puts. We had a risk reversal that was sold where they sold the puts and bought the calls, the March 40 32.5, and 6,000 D's 37 puts. Now, we generally don't see that type of aggressive bullish flow in EDM, and that was on March 11th after the market had reached basically a bottom after selling off for 7 days in EEM. I'll bring up the chart again so you can see this is basically where we saw put sellers in very aggressive bullish action. And of course, as we know, what happened today is the market was up pretty good. It seemed like the flow was telling us that we had put in a bottom in EEM and perhaps in the whole marketplace. And it indeed was so. It does mean you have to know the general flow in the name. You just look at put selling in a major market ETF like EEM, and it may not be, a screaming example of what you should do. But if you know the product is generally put buying and call selling for people looking to hedge their book, and then you see a massive amount of put selling, that's a pretty good indication that maybe we did reach bottom.
The thing that I've noticed is that on the products like EEM or SPY, SPX, the type of products where there's a lot of volume for people to do hedging, they tend to end up having, or some products tend to end up having a steeper put skew because there's a lot more put buying on it. Could you talk a little bit about how you see that on certain products versus others, and now you see this all the time.
No, this is really funny because you don't know what I was actually about to talk about next, which is another example, which is actually the movement in put skew. So let me bring up an exact example of what you're talking about. Like you read my mind. So this is one of the tools we look at to look at skew, underlying price. We can look at volatility this way. So what I did was I took a snapshot of SPY, the S&P ETF. On the top, we have the simple price, and everybody can understand that. On the bottom, what we have is a measure of puts versus calls. So if there's aggressive put buying and the volatility of the downside puts goes higher, you'll see the chart tend to trade higher. If you have call buying or put selling, you'll see it trade lower. So if you'll notice that towards the end of February, what we saw in SPY was a general rise of implied skew, put skew, relative to calls. And that was in the face of the market going higher. In general, you can see a lot of panic when we're going higher. You'll see maybe calls get bought for people afraid that we're going to break out. But as we traded flat to higher in the S&P, we saw put skew going higher, and that raised a lot of red flags. And it turned out that flow was pretty spot on as far as we saw the market correct just 2 days ago. Let me bring up a SPY chart. I don't know if I can put that up against. Yeah. So, the put buying peaked March 4th or 5th, and then as you saw what happened on March 6th, we saw the S&P sell off. What was that, like 1.5%, 2% on the day. And then after the sell-off, what happened is a lot of people take their profits, and skew is back down to relatively normal levels and no longer elevated. So what that means going forward for S&P, not really sure, but we're no longer at the extreme levels we were right before the market sold off on the 6th, on Friday. Is that more what you were asking as far as skew?
Exactly. One of the things, and I don't know if you want to show other examples, but at some point, I'd like to talk, you explain a little bit about, you do execution for a lot of institutional clients. What type of information do you end up helping them with to understand so that they can better hedge their book, increase their alpha, or whatever their objectives are? What information do you end up helping them to understand so that they can achieve those objectives?
Well, we look at various factors in deciding when a client has a certain objective. We can look at implied skew. We'll look at relative vol levels. We'll structure products based on the client's needs and the client's fears about a market. If a person is not that fearful of a huge move to the downside and skew is quite elevated, we might look to do a ratio put spread. If the person's concerned, they want to be protected to the downside, but they're afraid of a big move to the upside, we certainly wouldn't sell calls against buying a put. We wouldn't do a risk reversal. But if they feel the market is limited and there's no risk of an upside move, we might look to finance a put through selling a call. So there's various strategies, and it really depends on market conditions. It depends on where the VIX is. It depends on where the skew is of a product, whether it be SPY, whether it be IWM, whether it be the big SPX, or whether it's a smaller index. It's very product specific.
Now, I know you only do this for institutional clients, and the time sensitivity of the information that you provide is enormously valuable to them. But could you maybe show us an older one where there isn't time sensitivity? One of the newsletters that you end up sending out, just kind of walking through a couple of the examples on there of what you saw and the types of trades that you may or have recommended or executed for some clients?
I believe so. I guess I can bring up a past newsletter.
Yeah,
Just give me a minute.
Nothing recent. Like I said, nothing that you would consider sensitive. And I know that because the information is so time sensitive, if you brought something up from last week that you had seen some of the order flow. Okay, increase skew, decrease skew, or something. I know that the information is very, very timely. One of the things that another expression that I'll end up using, with our community, is that I'm not a big TV watcher, but my wife, one of her favorite shows is CSI. And I've heard the expression, I don't know if you've ever heard this one, this is more not an institutional one, more of a retail one. It says that if options, if the market, right, if the stock market was CSI, options would be DNA, right? Because so many times you get to end up seeing what ends up happening with the change in implied volatility and how people are willing to end up paying a little bit more or willing to sell something at a little bit less because of the market is starting to move. And this is, again, as I mentioned, probably one of the most efficient leveraged ways for them to end up playing those directional moves that probably the other part of their financial organization is about to cause.
Mm-hmm. I think that's about right. So here's an example of March 2nd. We highlight a few major market trades in our standouts, and then we break down what we're seeing as far as bullish or bearish trades. Some maybe no big deal. This DK buyer of 5,000 March 37.5 calls, nothing really stood out, and who knows? It could mean something, or it might not. A person who knows the name might make something more of that call buying. There were definitely some Qualcomm call buyers that came out, and it turned out I think they just did some kind of they just had some recent announcement that was pretty bullish. I didn't even make note of the fact that looks like Qualcomm call buyers did okay. I think the stock went from 70 to 74 from the 4th to the 6th. So these March 2nd Qualcomm call buyers did pretty well, assuming they got out. You never know which ones are going to, it's up to the individual to decide which ones are worth getting on board and which ones are you want to step aside. But I think having the information is pretty important. There are, I don't want to throw that out there without mentioning, so there are two situations that are really interesting to me. Believe me, I'm not giving any type of advice or a recommendation, but there are two names in the last few days that are sticking out as far as order flow that I think, if you wouldn't mind, I'll mention.
We would love to end up hearing it. And by the way, exactly what Matt just said. These aren't recommendations. I've seen when there's been huge order flow and huge bull. And one of the things I'd like you to end up talking a little bit about how you know when a trade is more bullish, and how you end up seeing the implied volatility or things being, where they're either being traded on the bid or the ask and what that ends up meaning. But what I have seen is that markets have become so efficient that if somebody's going to push them out of whack, okay, so that the volatility doesn't seem to end up making sense at some points, in at least a fair percentage of cases, and we have no way of knowing beforehand, but at least in a fair percentage of cases, it's because they have more information about what's to happen than we do.
Yeah, in the case of the SLXP, someone was in a position to know something, and I'm not going to go out accusing anybody of anything. And if you pile on board, it doesn't really matter why or how. But the fact is somebody knows something, and they're not afraid to commit capital to it. In the case of Pepsi, I don't know if people on the call are following along with the stock right now, but there's been heavy call buying. If you look at the bottom here, if you look at the green line down, that's the opposite of put skew exploding. That's put skew lower compared to calls. And the reason that this line has gone down is because of the aggressive call buying we've seen in the past 2 weeks, I believe. Nothing's really happened in the stock. Just the vol is now trading at such an aggressively high level relative to where it normally does, and skew is trading so aggressively lower to where it normally is that it feels like something is imminent. I don't know what it is, but somebody's buying calls for a reason. So that's an upside situation that people are betting on. And the other one that's really presented itself in the last couple of days is UNP. That's the other way. As you can see, as the stock has gone lower, we've seen some really aggressive put buying. This is put skew, and that's near-term put skew. And they do have earnings, I believe, in April. But right now, what we have is near-term March and April put and put spread buying in a really aggressive manner. Again, I have no opinion on the stock. I just note that there's definitely some serious flow, and someone seems to be positioning for something, and a lot of people seem to be piling on.
Matt, could you explain on this graph, and when you take a look
Sure.
at put skew, what exactly are you looking at in the graph, and how are you reading?
Okay, so basically, this goes back a year. This is the put minus skew, put minus call, and it's a ratio of put volatility versus relative to call volatility. Uh, and over the course of a year, based on the action in the stock, you'll see it move around to extreme levels at certain times before it eventually popping back to there's a range, relative normal range where skew normally lies. But when you see extreme levels, such as where it is right now, you want to look at what is the flow doing to drive the skew to where it is. It could be very well that there's massive amount of call sellers, but in this case, there's just a large amount of put buyers driving put skew higher. We have other tools that we look at volume, and we look at what calls themselves are doing. We can look at what actual at the money volatility is doing. I could bring that up also, but just it's more important to know that what we're seeing is aggressive put buying, and you can see that reflected in the skew right here. And it's following. Is the stock making the skew go higher, or is the skew making the stock go lower, or is the stock lower making the skew go higher, or is there something else that's going to be coming out? That's for an individual to decide before they commit capital.
Exactly. Sorry for the noise in the background. Matt, the tool that you use is not available to regular traders. Could you talk a little bit about a vol edge and risk edge? Not so much that nobody's going to go out and buy a $10,000 a month license like you guys end up having. But could you just talk a little bit about the types of information that you get from the tool, and why is it worth that much money to you per month?
It's a fantastic question. The guy who runs the firm, Mike Izaki, is a firm called FT, and the product is called Voledge. I'm sure he could spend a lot more time talking about the product than I could, but I've been using it for a long period of time, and to me, it's the best product available. I have no association with them whatsoever, so that is my unbiased opinion. It gives you the ability to basically cater how you look at volatility and how you look at skew and how far you want to look back. Based on a certain name, you can compare a name to another name. You can do like SPY versus IWM. You can look cross-product. You can look at events. There's some event analysis over here where we can look at implied moves. I'm sure everybody here is sophisticated enough to understand implied moves of earnings here. We can look to see what is implied. We can see what a historical realized is. There's a lot of metrics. It's too much to talk about in one particular call, but you can definitely cater how you look at certain flow and certain volatilities based on your needs.
I know it is. It's an incredible.
It's not plug and play. I'll tell you that.
No,
it definitely takes a little bit of time. Sorry.
And it also ends up taking, like I know, for example, you guys have built volatility models where you'll end up doing vol forecasts of what happens after an event, like let's say a big economic report or a big Fed announcement. But one of the things that I take a look at is that your clients kind of rely on you to end up interpreting that, and you don't make recommendations as much as you end up making observations for your clients to tell them that this is being particularly bought. Like the thing that I thought was just amazing was how you guys called December. I don't know if you saw, but there was a Goldman Sachs report that showed that in the fourth quarter last year, we had 2 of the largest 10 weekly moves in the history of the VIX. And you guys were on the right side of that vol, trade, which kind of blew me away because I looked at this, and every year that I've ever traded, vols come down in December, you guys were long vol going into December.
Well, there were 3 events. There were several events that had potential to be market moving, and it didn't seem like the market, while vols were maybe slightly elevated given the seasonality, given that it was the end of the year, it didn't seem that the market was pricing in the potential variance of the events.
Can you explain that a little bit? What did you guys see? And I assume that it was in your volatility models and in your risk edge and vol edge tools that you saw that. What were the types of events, or what were your clues that helped you to make that call?
I have to think back to what all the events were. I believe there was something out of Europe. There was some. We have the ability to add basically variance bumps to our model. Without going into all the mathematics of it, basically we can price in various events, and we have to estimate what the potential for the event moves are. But we can plug in various variance bumps and move to where we think the current vol should be. If people are looking for gamma, which is basically near-term exposure for a movement, we can price where that should be. And in the case of late December, it just seemed like the market was underpricing the moves.
No, it really was an amazing call. I mean, I don't know how you guys did it. I don't know, Tom, if you're on, I'm going to be boarding in the next couple of minutes. I'd like to end up opening it up to some questions.
Yeah.
Also, at some point, what we're doing right now, by the way, is that we're working with Matt and his firm. He has his institutional clients, and there are certain things where they consider to be, competitive advantage, extremely confidential. But what we're looking at doing is trying to end up getting their compliance guys to allow us so that Matt may be able to share some version of their institutional level service with our community, which we're going to work very hard. We don't know if we're going to be able to end up getting everything, but over the next week or two, we're going to end up hopefully being able to end up moving some of that forward. Tom, do you see any questions? Or I know you've been trading a long time yourself. Do you have, specific things, that you'd like Matt to end up kind of either talking about or going through other examples that he's seen and he's been able to help his institutional clients with over, the last period of time?
Well, Clayton asked, is the SKU available on typical retail trading platforms? It looks like the vol edge is so much more in depth. You probably can't really compare them.
I think there are platforms that offer SKU. I think IB may offer some version that has SKU, but in general, for the retail client, the E-Trades of the world really don't need to offer that. It's not generally not a factor that they offer, that they even need to.
Yeah. What LiveVol, what LVX or LiveVol platform ends up offering is that they offer IB at different levels, meaning they'll have the way the way vol edge and risk edge end up doing the normalized 30, 60, 90-day SKUs. LiveVol doesn't do that, but they'll do it on the overall IV level. Nothing about SKU, but yes, about IV level. One of the things I've seen people say, oh, well, because the 30-day volatility is down, that means that I should be buying, let's say, leaps. No, just because 30-day vol is moving in one direction doesn't mean anything about 365-day volatility.
Well, that's certainly true.
But what ends up happening is that, if people I've seen people take a look at, for example, the Thinkorswim tool, where they'll end up making their entire decision based on 30-day vol, but they're trading, 90-day vol. And there could be a relationship, so there couldn't be. So they at least get us that far. But there is and what some of the tools will end up doing, a lot of them might end up showing you a volatility SKU curve, but nothing that actually measures it over time. You actually have to look at it, and track it yourself.
So you can look at the current smile. Oh, I'm sorry, I didn't mean to interrupt, but you can look at the current vol smile is what it's called, the current vol curve, but it doesn't track it over the period of a year or 2 years or 3 years.
Right. Now, the only tool that I know that will end up changing the shape of the smile, and you can go back 2 years, is LiveVol. But what it doesn't do is it won't do, like, for example, I know that recently you guys ended up using, you changed the way you ended up doing a normal hedge in a lower vol environment because the vol skew got to like a 2.5, almost 3 standard deviation move because of the way you end up having a history on that. Now, you guys saw it with your tool. We would actually have to end up, we being retail guys, would actually have to go through live vol and look at it day by day by day and do the, the calculations, or by all eyeball saying, the curve looks a little bit steeper now, but we couldn't see it the way you end up tracking it.
Right. Well, we service basically the hedge fund community and institutional community. It's, people willing to, who need more detailed information as far as, a skew curve going back a year, 2 years, 6 months, whatever the case may be. The retail typical retail orders, of the smaller size, they're not really going to be able to capture the a 1 standard deviation move and skew. A lot of people trade more direction, just a straight outright, as opposed to trading a spread or trading a risk reversal. So I don't really have an answer for how you can, for how people can access this type of information on a retail basis.
Yeah, I've seen, I was just thinking about I'm not sure, do you know Paul Foster, just by chance? I know he's at CBOE.
I don't. Sorry.
He used to, I think he still makes a kind of a daily thing of what's going on in the market, similar to what you do, but yours is much more nicely formatted with actual trade ideas. But, Paul's a researcher. He just sees what's moving, what vols are doing, and that kind of thing. Similar to what you're doing, but you have a nice format with trade suggestions. And just curious, how long have you been putting that out? Because it's really good information.
We've actually been fine-tuning it for a couple months, but I think most of the production of what we had recently is just in the last few weeks, actually. We've had a little bit of a demand for it, and people are interested in this type of thing, so we've decided to expand. We do 2 reports a day. We do one, which is a recap of the day before's flow, and a little bit of analysis on it with some highlights, standouts. And then midday, we do a little bit of a commentary. We actually have an index strategy that we look at for people looking to hedge. That's more for our institutional clients. We look at ETF flow. We look at equity flow. We look at some major changes on the day. These are a 30-day vol change, and these are in relative terms. So when you see something that's up 10%, it maybe went from a 30 to a 33, for example. We have some names there, and this report, I think, is about a week old. We have names that are relatively cheap or expensive to a forecast we use, which is basically somewhat of a realized vol function. It has some little bit of proprietary information in there, but it also shows the percentile where the vol is on a 0 to 100 basis over the course of the last year. And then we highlight some opportunities. There may be 0 one day and there may be 10 another day. We try and keep them timely. These aren't actual suggestions. We don't tell you to go buy the 48 call in some name because we think the stock's going up 10%. We might see a situation for people looking to play upside or people looking to play downside, and we might talk about a strategy that we think is appropriate given the situation. If calls are really cheap, like if you could see in Microsoft, we thought calls were really cheap. The vol, the upside going into earnings was really cheap. It just so happens that vol is now at a recent high, and it turns out we were pretty much right on that, which is nice to be right once in a while. But, we look at situations. We look at risk reward, we look at situations, and we make recommendations. I wouldn't even call recommendations, but we give our advice based on that.
Or your opinion. Yeah.
Our opinion. Don't want to say specific recommendations. Here's the here's the Microsoft graph, by the way, the vol graph. You could see where vol went from like the low 18s to 20.89 where it is now. So it actually went up. What is that? About 15-20% over the course of the last week. So
it's just your interpretation of how you're reading the tea leaves that the options are providing.
That's correct. I mean, are there any questions? I mean, if there's a name people want to talk about, I can help them look at something. I won't make any specific recommendations, but I can talk about anything about the floor, about vol, about skew.
There's no questions yet, but I was just curious, how do you kind of go through your routine to find this kind of stuff? Is there specific things you're looking at, like initially during the day, or if you're like trying to zero in on a particular stock, or you know, what kinds of things are you looking at?
You know, we have a general list of stocks that we look at on a day-to-day basis, but we keep it open to any smaller names that might attract really large order flow. We kind of have sniffers on the various exchanges. We have an electronic functionality that if something trades, we're able to look at it further and see if it was bought, if it was sold, how many. We can look at the open interest. And then it's up to our own due diligence to look at the name further, to look at the vol, to look and see if there's any potential news out there. You know, it's definitely a little bit of a manual labor process. I mean, we're automated as far as being able to see a lot of the flow, but the analysis from there takes a little bit of. It's not something that an algo can sniff out necessarily, because there might be various reasons for why the volume is doing what it's doing.
Makes sense, which is good. That means it's hard to automate. So, still no more questions.
Oh, I'm sorry.
I was going to say there's still no questions. So if you have some questions, please type them in the chat.
Is there a chat that I can see, or
there is. If you put your mouse up at the top of the screen and that thing comes down, you'll see chat.
Thank you. Okay, retail platforms. Okay.
Gary, imagine that.
You know, it's a good thing for all of us, right? I mean, once the market goes all algo, then what are we all going to do? You know, I would love to say it would be really interesting to see algos try and sniff out order flow and try and trade directly on it. You know, they don't know whether to hedge. They don't know. I'm sure they know that a percentage of time an order is correct, and they could probably pile on and expect a 27%, you know, failure rate or whatever the number might be. But I don't think any firms would really want to commit a large amount of capital to that. So hopefully we keep a little bit of a human intelligence aspect in it.
Hey, Tom, I'm now sitting on the plane. Okay, so I'm going to have to end up going on to mute until they make me hang up. Could you continue to end up asking, just the way I was, to go through, you know, any specific examples? I know we've been going for a while and we're close to the edge, but I kind of have to hand the ball off to you at this point.
Yeah, that's fine, Jim. Have a safe flight, and we'll see you next time.
Hey, George, absolutely. We did see, I think, about 4 days in a row of put buying in Intel as the stock was leaking lower. I think the stock was even leaking lower while the market was trading towards highs. We saw about 4 or 5 days, and you can see this green line. This green. I can bring up a 1 month also. You can see the rise in volatility over the course of the past week and a half. So people suspected something was going on in Intel. You can see where the skew rallied. It didn't really rally that aggressively. Let's see what the 1 month skew did. Yeah, it rallied a little bit, not to crazy levels, but the overall volatility went up. So it did seem, and it was definitely on the put side. So I would say the market did anticipate somewhat, not as egregiously as some of the examples I've given, but there was definitely aggressive put buying in Intel for, I think, the past 4 or 5 days. And we highlighted it on our newsletter. There were definitely a couple mentions of heavy put buying in Intel. Volage is not a Bloomberg product. It is the product of a company called FT. You're happy to look them up. Really good people, very smart. It's a great product. It's a little pricey depending on your needs. That's interesting. So CMG, was not a contrarian, actually. If you're talking about, are you talking about the earnings? We look at skew and vol as relatively cheap in CMG. We were pretty aggressive saying that things looked cheap ahead of the earnings. So we did kind of catch that. The order flow did not know ahead of time that CMG was going to miss and go lower. We thought it was cheap, but basically, if there's no other order flow, we will look at a cheap or expensive relative value as a way of looking at things. But in the face of heavy order flow, then we might go the exact opposite. So how I would approach it here is really not heavy order flow, giving us strong direction. So not a very aggressive position here. Skew does look cheap, puts are cheap, vol is cheap, but no, can you guys hear me?
I can hear you. I'm just typing into...
No. Jerry asked about if we lost the audio.
Yeah, I was just typing. He might have lost it, but I just told him to rejoin the audio broadcast. But I can hear you fine. Should be okay.
You know, there's two ways that a lot of people look at things. They look at things from a momentum position, and they look at things as a contrarian. If things are cheap or if they're expensive, they need to be bought or they need to be sold. But if you're a momentum trader and things are high, you know, you want to buy them, and if they're low, you want to sell them. And to me, it's basically a matter of order flow. If something looks cheap and no one's out there buying it, then maybe it's worth it. But if things start getting expensive and people are buying it, then I think you want to pile on board. It's kind of a, I don't know, not reverse psychology, but it really depends on where the flow is. It's definitely a situational thing with, you know, some things, if people are not that interested in it's cheap, maybe it's worth buying. But if you see aggressive order flow, then I don't think you don't want to sell something that's expensive if there's heavy volume.
So a lot of the opportunities or opinions of things that you put out in that newsletter, what kind of time frame do you anticipate people acting on those? Is that something
Sure.
for like the next few days, next few weeks?
You know, it's definitely not, you know, there's a lot of people on Twitter that like to follow flow, and some of their stuff is like hourly. You know, they might get on board for something, and they might be piling in of calls for 43 cents, and, you know, with all the people getting in and the stock goes up, you know, 25 cents, and they look to sell it at 60 cents. That's definitely not what we're looking to do. We look at from anywhere from a day to, I'd say, a month. You know, this Pepsi buying has been for a couple weeks. So, you know, what is the end game in there? I don't really know.
And I imagine that's due, I guess your customers are fairly large, so it wouldn't do them much good to have a trade that's on for, you know, a short period of time, like an hour, because they just couldn't get the volume on.
No, and that's not our that's not really what our intentions are, our goals. A lot of our institutional clients generally have an opinion or at the name, and if something fits, then they'll get on board. If they happen to like a name and they see a reason to add to a long, or if they're short and they want to add to a short, or if they want to hedge their short, depending on what they're seeing, it's definitely situational.
Bruce is asking, what's your newsletter? I guess this is more for your private clients, but you mentioned that you're thinking about expanding.
You know, we've had pretty strong demand from our institutional clients. And I'll tell Bruce that what we put out at every single morning is a review of yesterday's flow. We'll have some commentary on it. We'll look at each individual trade that stands out. We'll make a volatility comment, or if something looks out of whack and it smells funny, we'll mention that too. And then at the midday, we put out a product that has that day's flow. We also talk about some volatility standouts. We do give out specific advice on certain things, not as far as like strike and month. We'll give some commentary on what we're seeing in certain situations, and we'll talk about the market and what we're seeing there in the ETFs, not just in single stock. Because as I mentioned earlier, it was some of the ETF flow has actually been pretty prescient as far as EEM, the bounce in EEM, and the market sell-off as we saw a rally in SPY put skew.
I think Bruce is asking where to get it. I don't think it's not available now, but maybe we can twist Matt's arm to have some kind of offer for discussions.
Sorry, Bruce. We're trying to put something together. All I could say is be patient. I don't think you'll have to wait that long.
And then George asked, are there dark pools for option orders like in the stock market?
There are. I don't think they've gotten a ton of traction as they have in stocks. I think obviously the toughest part is seeing volume, but it's on a dark pool and it's hard to get access to the information. People don't want to necessarily put that information out there. So I really can't comment that much on it, but only to the effect that I don't think they've gained a ton of traction. I technically am a broker. I do execute for Englander, but I do have pretty extensive background in the marketplace. I was a specialist for a number of years. I traded upstairs on a prop desk and on a correlation desk for a large bank. So I've been around the block, as they say.
Definitely. It's nice to see the other side of the option traders. We're at Capital Discussions primarily retail guys, so it's nice to see the bigger side in the market, the institutional side, what tools they're looking at, the kinds of things you're advising them and that they're doing. So I appreciate the look into the other side.
Bruce wants to know, I'm sorry, let me try and go through the chat here. Bruce wants to review a day prior flow. Are you looking for specifically like yesterday? The morning, we put out a morning report that we try and get out around 7:30 a.m. Chicago time. That has a review of a lot of significant trades from the day before. We don't obviously capture every trade. That would be ridiculous. You don't want to read through 50 pages of trades, but we try and put the most significant, the ones that stand out, not just the ones that we have an opinion. We're working on it. Let's see, Steve. It really depends, Steve. We put it out to institutional clients, Bruce. They're currently like mid to large hedge funds that we execute for.
That said, we are trying to get a version or maybe the same one in the hands of Capital Discussions customers, and that's what we're working on, but we'll see. Hopefully,
and we'd definitely open to feedback of what people would like to see as far as flow analysis or trading opinions, et cetera, skew, vol, flow analysis, et cetera. There was a question about EEM signifying a possible bottom in the market. Is there another underlying product to confirm, say another ETF? Sure. I mean, there's SPY, there's IWM, there's EEM, there's EFA, there's the Qs, and really what was significant wasn't just EEM itself, was the unusual flow, because usually what we have is hedge funds like to hedge their book. They might like certain names, and they like to use the ETF products to hedge their market risk, their beta risk. And so generally the flow in those is of the bearish nature, put spreads, put spread buying, put buying, risk reversals. When we see something that's tremendously bullish in an ETF, we take note. We've seen recently in the last week, we've seen FXI, which is the China ETF. We've seen a significant amount of put selling. Does that mean that the index is going higher? I don't know, maybe, but I do know that the flow is telling us that we may not be going down in the near term. So basically we look for outliers rather than just general flow. It's very, obviously, as I said before, I used the word before, but situational. It's knowing the name, it's knowing what type of flow you normally see, and that just comes from experience and watching the marketplace.
And I did have a question on the report that you send out. Are there parts that wouldn't be appropriate for the retail trader that would only really be of interest to the institutional guys?
We have our index strategy that we look at, ways to hedge a book. I don't think retail people would necessarily really care about that. I think it's kind of noise. Doesn't really apply. If you're not looking to protect, a 600 basis point move down in 6% move down in SPY, over the course of the next, 6 weeks, it may not really apply to you. The most crucial secrets that the institutional traders do not want the retail traders to know. Then I'd be kicked out of the club if I told you that, wouldn't I? Let's see. What are the disadvantages we are at versus institutional, especially in regards to order execution? You know, what you have to remember is that these institutional traders have a lot of sources of liquidity that they pay a lot of money to. So where you might have a market fade on you really quickly, these guys have banks that are bending over backwards to make them markets, and sometimes to their own detriment. They provide liquidity to these funds, and if a fund has a really good sense of something going on with the company, the bank can get really run over. But like I said, the disadvantages is that you're right. Well, the market depth isn't really there because your algos aren't able to necessarily sweep as fast as some of the bank's algos. You know, they have the co-located servers that are able to sweep a market. You know, they can sweep 5 exchanges at the same time. You know, if there's 1,000 there, they can get 1,000 generally. But they express frustration sometimes too. It's not always rainbows and unicorns for these guys as far as execution. They run into a lot of the same issues. No, I understand. Well, and the bid ask and execution charges make it that much more difficult, right? You know, you have to pay commissions, and you know sometimes you have to pay an extra nickel. Look at the old days, though. It used to be when things are in 16ths and eighths. It was that much more difficult for the retail investor, which is why the volumes were so much lighter then as they were now. Now you lose 3 cents, you know, which is a big deal, losing 3 cents. But in the old days, you would lose, you know, the equivalent of 12 cents.
Well, Matt, we're approaching an hour, so this might be a good time to wrap it up, and really appreciate you coming here and sharing all your experience and your tools, and it's been great to have you. Thanks.
It's certainly my pleasure, and I'd love to do it again. Hopefully, we can get this. You know, it seems like there's interest in you know, a flow type newsletter or a volatility type newsletter or some hybrid thereof. And if people again have suggestions or requests, we're going to try to do something hopefully in the next couple of weeks.
Fantastic. Love to see that. All right, thanks everyone for sticking with us to the end. And Matt, thanks again. Enjoy the weather in Chicago. I missed the pizza there. So go to Gino's East and have one for me. So
I'll certainly do that. Thanks so much, everyone.
Thanks so much. Thanks, everyone. Bye.
Have a good night.